So far we've looked at why we need to think about the profit and the cash and the wealth effects of a business in order to understand fully how it is operating. Let's now look at a practical example that shows how these three ideas, profit, cash and wealth, are linked together to tell the full story. In this example, we'll look at a crop livestock farm business and how it may perform in the coming production year. We start with the balance sheet on day one. We've got 2,000 hectares of cropping and grazing country worth $4 million. We've got $1 million worth of machinery. We've got $500,000 worth of livestock. Add them together gives us our total assets. On the other side of the ledger in the balance sheet, we've got a debt of $1 million. It's a 10-year loan with 10% interest rate charged, and it's just started. So our balance sheet at the minute stands as assets $5.5 million and debt $1 million. Assets take debt gives you net worth or equity. So $5.5 million assets take $1 million debt leaves us with a starting equity in the business of $4.5 million. An important measure is equity percentage, which is the equity expressed as a percentage of total assets. In this case, it's $4.5 million as a percentage of $5.5 million, which is 82% equity. Now let's look at the profit we might make over the coming year. To do that, we estimate the gross income, and for this farm it's $1 million from sales of grain and livestock. From that we deduct the variable costs, which are the costs you spend to produce the income, of $600,000. Gross income take variable costs leaves a total gross margin for the farm of $400,000. Overhead costs are $200,000. This includes operator's allowance for labour and management and depreciation. Leaves an operating profit or EBIT of $200,000. That's the return to total capital and is 3.6% return on the capital invested. The financiers of the business need a share of that, so they take an interest of $100,000, which is 10% on the $1 million loan. Leaving a net profit of $100,000 to the owner with tax of $15,000 leaves growth in owner's equity of $85,000 for the coming year. A return to owner's equity of 1.9%. The cash story is different to the profit story. In the cash story, we have $1 million cash income, and then we've got various uses of cash. There's $600,000 cash variable costs. There's $125,000 in cash for the cash overhead costs, and there's $75,000 investment out of cash flow in capital expenditures. A net cash flow before we pay principal and interest is $200,000. From the $200,000, we then pay $100,000 in principal, $100,000 in interest, $15,000 in tax to give us an overall net cash flow for the year of minus $15,000. We started the year with $4.5 million in equity. We've run the farm for the year. We expect to make $200,000 profit and net cash flow will be minus $15,000. We have an end of year balance sheet where we still have $4 million in land. Our machinery is depreciated to $925,000 and we still have $500,000 in livestock. Then we have $75,000 in new capital investment that we made out of cash flow. The debt situation is now we have a $900,000 debt, having paid $100,000 off our initial $1 million debt, and we've incurred a new debt of $15,000 from the cash flow deficit. The new equity is $4,585,000, a growth of $85,000, the same as calculated in the profit and growth budget. New equity percentage is 83%.